just the dynamics of managing other people's money, right? Like the last thing on earth you want to do is, if you've been bearish, to flip bearish at the wrong time, or to flip bullish at the wrong time, because then you compound the lashings, right?
Right.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate, and actual performance may differ. As always, please remember investing involves risk.
And we are back with another edition of the Daily Dots, and I am joined once again by the Brain Trust himself, Mr. Chase Taylor. I'm trying to think of a superlative or a nickname to give this rally here.
The bear market rally that wasn't a bear market rally.
Yeah, there you go. And one of the things... You still got to clear a hurdle on the S&P, right? We still haven't made a new all-time high on the S&P, and we'll get a rundown on the indexes here. So I'd like to see that S&P break out. Having said that, did I block you out there?
Maybe.
Yeah, there you go. Having said that, this reminds me of so many. This market is behaving to me like so many other times where you saw a lot of consternation, a lot of back and forth, and then it's like you kind of stayed in that tight zone where bears still had enough to cling to say, oh, it's going back down. Bulls did. And every time in the past, it was almost like that market was coiling and then, kind of teased you and then boom, blasted off. It's hard to wrap my head around the fundamental side of it, so I'm not even going to try. I mean, on some of the companies, their earnings look good and stuff like that. But at the end of the day, to me, it feels like the whole passive ratchet game is starting up again. Yep. And now, the one thing I will say that I think is really interesting about this move is, even with some of this ridiculous tech crap running and the crap companies that are ridiculous and all that kind of stuff, it's not sucking capital away from other areas like it has in the past. Like, for instance, when that stuff, so many times over this cycle, when that kind of stuff took off, everything else just stood still and watched it. And you're still getting good performance in overseas markets. You're still seeing admirable showings in precious metals. With gold flat today, miners were up more than the market. The rest of the world was up more than the S&P again. Industrials in the U.S. continue to perform. So it's not just tech. That's fascinating to me. The one thing I will say, though, is I think people need to be cautious about being too bullish here. And the reason why I think is because I do not think, although it looks very clear to me like we're breaking out, I wouldn't be shocked to see us move substantially higher. But those reasons and those impetus and with those foreign markets running now, I think they're going to continue to get fed money from U.S. concentrated portfolios. And I think you're kind of seeing the proof case of that right now. It's odd. When I see a really good day in U.S. markets, I expect to look at everything else and just see it standing still.
It maybe the key there is the dollar. If you think about it, we're so used to the dollar going up with the market, and that tends to, be combined in those where you look around at every other asset and it's just flat to down to maybe up a little bit while, Mag 7 or Qs or whatever's up. Maybe I think dollar down just offers so much to, especially the rest of the world equities,
Dude, well, and that's the other thing too. And that's, I think that's been one of the driving forces behind us saying, it's been me. I know that we're all in agreement on it, but that whole look, regardless of what you think, you don't have any choices, meaning we've got to be, when you look at the valuation spread and how cheap so many of these international markets are, and then you start factoring dollar moving lower on top of that, whew, and then oil where it's at. I mean, you want to talk about nirvana for emerging markets right now? Sweet Moses.
Not to mention all the deflation they've imported from China that allow them to slash rates. So they're getting to cut their interest rates. Their currencies have picked up. Low inflation, growth pretty good. Like it really, cheap oil. It is cheap agriculture. Like it is the perfect setup to get. And you see it. I mean, with Greece and Poland and stuff up 50% on the year, like you are seeing the result.
God, I wish we would have had more time to build that Greece position.
Yeah.
Thanks to you. No, it's a good call by you. I mean, thanks to you, we've participated in the lion's share of that, just nowhere near in the size we would have wanted to.
Yeah. In a perfect world, it'd been 7% that bad boy. And,
7, even as high as 10 potentially.
Yeah. Well, in our tiny little portfolio, we could do that, but only because it's tiny.
Anyway, why don't you give us a rundown on the indexes and all the data?
Yep. So S&P closed up 0.8. We had touched the all-time high today, but did not close above it, barely. Q's up 0.94. Small caps up 1.6. So beast mode day for smalls. Equal weight up 0.75. Mag 7 up 0.94. Dollar down another 0.4. Dollar's now at 97.3. Very, very weak. Bitcoin just keeps going flat. You're up about 0.7 on oil. I'm not going to quote gas because it expired today. Yeah, like you said, gold literally flat. But then you had silver up 1, and then the monsters today, platinum and palladium. My favorite metals up over 7% each on those futures contracts. And then copper also strong. So all the industrial stuff just powered through. Copper up 2.8%, back above $5. And then speaking of, stimulative vibes, you had the 2-year down another 6 basis points and the 10-year down about 5. So yields have come down a lot. And speaking of data, I mean, all week we just had terrible housing data. Housing's in a bad spot right now. But if you look at the 10-year, you have gone from, 4.6 to 4.24, something like that. So like, I would expect some of the data to start getting a little better. Home sales pick up. Now we need it, you really need mortgages under 6 to give them a real boost. But still, it's better than it was a couple weeks ago. So I would think that can stabilize a little bit.
I continue to be
and falls back under 19.
I continue to be puzzled by the move-in rates.
I think it's kind of two-pronged. One, you've gotten bad data, so you got the growth angle, and then for whatever reason, people are trading on the whole like replace Chair Powell thing. Because they started talking yesterday, like, oh, we're going to line up the candidates, we're going to name them early, and for some reason, all the headlines made it seem like I don't know if the market thinks that's happening tomorrow, and we're getting a bunch of rate cuts, and that's the reason I think a hot inflation print or two could unravel a lot of this party, because everyone's convinced themselves, because we had 3 good prints in a row, like it's over, we're going to get rate cuts, it's all good, no inflation. So if you get a couple hot ones, I think that would mess with a lot of trades out there.
Yeah. Did I see a print for GDP come in today? They
did the relook of Q1 today.
Okay. What did they do?
It was worse on growth, and mostly because of consumption, like and especially consumption of services was just bad. But at the same time, it's pretty clear that stuff picked up in Q2, and we're having a solid Q2. So I think second half is going to tell most of that story, because Q1 was so weird with the trade stuff, and Q2 is basically the mirror image the other way. That Q3, Q4 will help us a lot better figure that out. And one way to look through crazy GDP numbers is just to look at the final sales to domestic purchasers, or whatever it's called, as a proxy for demand instead of all the other junk that goes in there, like government spending and everything. And that's still totally solid. That shows you, hey, people are spending money, economy's fine. Which, other than housing, I think it's pretty clear to me the economy is fine.
Yeah, it continues to surprise me, because it's a hard one for me to wrap my head around.
So something I was hoping to talk about is we have obviously, like we touched the new high today. The Qs are at a new high. I think a lot of people are, you have a lot of people throwing in the towel that were bearish, and then you have a lot of people ready to drop everything and chase hard.
Yeah, and they have to. That's what we were talking about.
And I think it's an interesting setup because of, and hey, you have rates coming down. Like you have a lot of good things going on. But I'm seeing this like potential break higher, and I could even imagine like a 4% up week or something where everyone's like, oh, it's on.
Yeah.
But to me, we're going right into a bunch of dominoes that could fall that are concerning. And more than you usually have in any given moment. And we've talked about some, like, well, probably all of these at some point, but there's a lot of the stuff that has like the next month or two coming. Obviously the tariff deadline for July 9th for all the reciprocal tariffs. We've had no trade deals. Probably don't get one, but between now and July 9th that matters, I wouldn't think. So how that plays out, which none of us know, it could be a total nothing burger. It could be huge. Like none of us know. I would say even more important to that, it's the Section 232 tariffs. Those are like the sector ones. So we currently have them on autos and steel and aluminum, but they also have lined up, lumber and trucks and pharmaceuticals and chips and I'm missing a couple, but so there's a whole bunch left in the hopper that are going to have their own sectoral tariffs put on, and those are largely going to be applied to everyone, and then they've made those very hard to get out of. So you have that, so kind of two trade things still lingering. Then you have, well, one of two things happens with the reconciliation bill. It struggles to pass. Obviously, the market would not appreciate that, but once it does pass, they have to go refill the TGA, which becomes a big liquidity drain, which the market usually does not appreciate. And then we also have the last like 4 weeks, global liquidity's come down. That tends to lead the market by 2-3 months. So the market does not care at all right now. So you could have the market rip higher, break out while global liquidity is falling and kind of giving you the nod that you should be careful. Now, obviously that can turn itself back around and not matter, for that lead time. But given the U.S. situation, the liquidity drain to refill the TGA after this bill gets signed is a big draw for global liquidity. So you might have that global liquidity thing stick lower for 2 months, like for that 2-3 months, long enough to become a problem for the market. So you could have trade, liquidity, all sort of hitting in the market at the same time, right when everyone's piling back in and just throwing caution to the wind. I just find that interesting. And then obviously like the stuff we always talk about, the systematic stuff, where one of the reasons I've been pretty bullish in the last month or two is just obvious. All the systematic people sold and they're going to have to buy it all back.
Yep.
Well, they're buying it all back. So if they get really full, going into say mid July or whatever, if they get really full and then any of these things I just mentioned just kind of trips us up and you go back down, well, now they're forced sellers again. And you kind of have to have that 5 to 10 to 15%, little drawdown. Right now, I would say I would expect, 7-8% drawdown at some point later this summer, unless the trade thing becomes more real, which no one expects. No one's pricing any trade problems whatsoever anymore, and I don't think that's crazy given the
not the overtures coming out of the White House. I mean, Trump he even said today, I don't know if it was in a statement or if it was an interview, but he said something along the lines of he alluded to the fact that we can bump tariffs back, no problem,
right?
So I mean,
it seems like the appetite, at least for him at the moment, it's just not there to go hard on this again. And I think how bad the markets got probably spooked them, of course, but at the same time, like they're still high right now, and then we have all the section tariffs, the fact that we haven't had a deal with anybody other than a meaningless one with the UK. Like, who knows? But you can see that stuff looming out there. And one of the other things that I don't think anyone was talking about is like the pushback from other countries. A lot of people have been like, oh, well, you're going to give us a 90-day reprieve and let's talk about it. We'll hold back all of our responses that we have planned. But at some point, if you keep getting, strung along, maybe some of these countries are like, all right, you know what? Like, we're not just going to sit here and get baseline tariffs. Like, we're going to put up our like answer to it, which the EU kind of like alluded to like recently, like, hey, like we're not just going to sit by and get 25% on cars and 10% flat and everything while we talk and not do anything back.
Yeah.
Like eventually we're going to put some of our own stuff up. So even if we keep it chill, maybe some other people around the world don't. And that alone could be its own market, small market event.
Yeah. No, it'll be, to say the least, it'll be interesting to play out. If I was going to point out something here, that can, well, I mean, I think there's a lot of things to be concerned about, obviously, but when you look at where valuations are here in the United States, when you look at the potential for things to go poorly, you just got to market. My one fear, mechanically, I think you're headed higher. The fear is, maybe I'm overplaying this, but my fear is if that starts to happen in earnest, if U.S. markets continue to break, and again, the Qs have broken out, the S&P is still hovering there. I'm talking like get a good 5%, a beachhead 5% new all-time high, keep moving higher. I think you got a scenario where you could snap a lot higher pretty quick. Like you said, a 4% week, I wouldn't be so shocked to see a 10% month. And I think, obviously we have to see what comes down the pipe, but I see a potential setup here to trap a lot of people,
Yeah, 100%.
Because you do have genuine, you don't see anything. Again, I wouldn't say you see anything. I mean, housing is very troubling. I just don't think because of the dynamics in the marketplace that housing will have the weight it has on the economy in the past, meaning it's not going to be a positive for sure. But when you counterbalance that with the deficit spending going up another 500 billion this year, I think you have a potential setup to where all of this price action could really be masking some weakness underneath the surface with consumers and stuff, and that could hit rather quickly. I think you could kind of have a caught with your pants down kind of moment here. Because I think that I think that you're right. It's very hard for me to believe that you got a bunch of investors and money managers around the world that have lightened it up on their U.S. exposure. But if it looks like that thing's going to break out and run again, it's just like we've talked about. It's a professional risk side of it.
Especially if the dollar were to bottom and move higher, because then all the rest of the world stuff would take on water and everyone would feel the pressure to go back.
Yeah, I'll tell you.
Speaking of, so the U.S. is up about 4% on the year.
Yeah.
There are 9 countries up 30% or more and 20 countries up 20% or more. So even with the U.S. crushing it in June, still, honestly getting dominated by a giant chunk of the rest of the world.
Well, and you're not seeing the reversal, more importantly, right? It's not like the rest of the world's holding its lead. It's extending it.
Yeah, I mean,
on up days here in the U.S., almost every single time, international is still outpacing it, which I find very, pretty amazing. And I find it encouraging considering how we're positioned.
That very much depends on U.S. inflation staying chill, I think, though. If tariffs are inflationary, and none of us know in the next few months, if you start getting inflationary prints coming through that are hotter than expected, and it's kind of clear it's from tariffs, then it gets weird, I think, for dollar higher, rates higher. And then I think you get both U.S. problems and rest of the world problems equity market wise, where it's just hard to get equities up unless AI profits and performance and everything just is enough to drive the big AI top 10 winners to just drag the whole damn market higher. But other than that,
well, it'll be interesting to see how Meg 7 reacts here, because I'll tell you a little more recently with Tesla, but Apple has conspicuously not participated in any of this rally. I mean, it's just been stuck in the mud.
Yeah.
And Tesla, other than that one day, the BS day where it rallied, on robo-taxis, was up 8.5%, 9%. That thing's been stuck in the mud too. It'll be interesting to see what the indexes do with those stocks not moving in unison.
It's really become, and tech has really become a AI haves and haves not story. I don't remember who it was, like maybe Goldman or Bank of America. Somebody has like they have, I think it's Goldman. They have both of those in baskets. The basically AI winners and AI loser baskets, and they didn't diverge that much for like the last year or whatever. And then lately, the AI winners are going straight up, and the AI loser basket's getting hit. So like that gap is just like ripped open here lately. And you see with like Nvidia, I mean, just getting after it in the last month. So you can see like, okay, the AI stuff for whatever reason is making a pretty strong push.
Other thing you got to consider too is a little bit different dynamic too. And I know you've probably talked to some of those guys, but a lot of managers who have actually done very well through this cycle are actually having tough years. There's a lot of active managers that are negative on the year. They came into the year betting tech hard early, right? Took hits, and just their executions has been off. They've been doing the wrong thing at the wrong time.
Right.
Reason why I bring that up is when you're trailing, that impetus, that professional risk thing, putting money to work, you feel that pressure way more when you're trailing.
Oh yeah.
And I was just sitting there, we hit our high water mark on the year and we still got a lot of year left, but
more than half.
Yeah. Being up better than 16% on the year though, it gives you time and cushion to readjust the things that are coming down the road where, and look, I think that this could be bullish the market, like I was saying, because there's a lot of those guys that haven't still deployed all their cash because, just the dynamics of managing other people's money, right? Like the last thing on earth you want to do is if you've been bearish to flip bearish at the wrong time or to flip bullish at the wrong time, because then you compound the lashings, right?
Right. And the time to be bearish is not, or the time to be bullish isn't when everyone else is. And the time, so you're going to be panic buying when everyone else is doing it. And it's not how you want to kind of be, on the other end of the crowd, at these inflection moments.
Yeah.
Just like when everyone was wildly bullish coming into the year, like to total extremes that we covered in detail, like that was the time to be cautious.
Yeah.
And then, the last couple of months, it wasn't. It was time to get in there and buy some stuff. But now that, what the fool's going to do in the beginning here or the end here, like it could be time to back off some.
Yeah.
At least I'm not saying for like some big problem, but for
no, we've been raising cash.
No one's going to be positioned for like that 7% drawdown.
Yeah.
And then if you have it at between 5 and 7% in that drawdown, everyone will be reconvinced themselves that the world's going to end, and that will be time for thoughtful people to go take, monetize their little hedges they had and like go shopping again.
Well, and that's the other thing I think people are going to have to get, wrap their head around, which is, look, I don't think anybody can put a recession off the table in the next 8 to 12 months. That could certainly happen. Sure. But here's something I don't think people are thinking about. If that recession isn't that severe, you could see the market move higher throughout a recession.
Yeah. And
especially when you're running 7 to 8% deficits.
Yeah. And if AI is unperturbed by a slowdown in the economy, like then all your big tech earnings are fine. And like, yeah, who cares?
Yeah. Yeah.
Now, if you're long the Russell, you would care, but if you're long the Russell, I don't really know what you're doing anyway, I guess. But
yeah, I mean, I guess the Russell right now is just responding to lower rates.
Or if you're long home builders or whatever, like, yeah, like this would be a problem for you. But will the S&P 500 get smoked just because of it? Maybe not.
Yeah. No, well, to me, it's all a question of severity, right? Like, for instance, you look at unemployment going up, when you look at the deficits, the fiscal situation, all the different things that we know and talk about all the time, it would not at all surprise me to see an environment where unemployment, let's say in a recession, got up to 5.5%. And that would definitely knock the market around a little bit. But in that environment, I would not be shocked to see the market come out of that quote unquote recession from a higher level than it entered. Right?
Yeah, right.
Because of the AI drive that you said, because of tech being in such an odd spot, meaning, those earnings that are the disproportionate majority of S&P 500 earnings are probably more resistant to U.S. domestic economic situations, right, or conditions than any U.S. stock ever has been, right? And by way of 63% of their their wasn't that the number we pulled out yesterday? It was like 63% of their profits come from overseas.
No, it was like
It's like 50.
For Mag 7, it was the weighted average was 44.5.
Okay. So, but still, you know what I mean? Like, when was the last, you've never, I doubt you've ever had a situation where, the top 5 companies in the S&P 500 got nearly half of their profit from overseas. Right. And then they would also benefit from a falling dollar as well.
Yeah. And that's where, again, it could get interesting. If I could see a situation where the dollar bottoms, and then we've had plenty of periods of time in the last decade where the dollar was strong and the market was totally fine with it. For some reason, it feels like this time, because of the tech focus, it's possible that the dollar, at least in the early innings when it turns around or whatever, or if it moves quickly with rates, you could get in a situation where rates up, dollar up, like really upsets equities. That would be something to watch. And I don't think I made this point yet, but I made it, before we were recording. And this is speculative. None of us know what happens with inflation when it comes to tariffs. But what is important to say is, because the other countries aren't doing tariffs the way we are, if they do prove to be inflationary, then we have inflation and no one else does, which means we have to hold rates high and no one else does. And that would be a powerful driver to get the dollar higher. So you have a weird squeeze there.
Here's what I would look out for, though, in that scenario. Okay. I think one of the biggest macro mistakes that has been made over this entire cycle is identifying potential weak spots and breaking points like that, right? And what we've seen happen so many times is, I just think about you and I, where we'll target the right thing and we're like, hey, it's happening. That thing that we're talking about is happening. And then it just kind of fizzles and undoes itself. I honestly think that one of the biggest drivers of that dynamic has been central bank cooperation, right? I mean, meaning there's been several times where all of a sudden, you're watching this thing happen, and it's, we saw it with the DXY when it touched 116, where you're like, okay, I would expect this to keep moving higher just based off momentum and reflexivity. And then all of a sudden that dollar rally just evaporated, right? Remember, and I don't have proof, and I'm not alleging anything conspiratorial. I've just seen multiple situations where I'm looking around, scratching my head, go, this doesn't make any sense. And you're like, oh, wait a second, right? The central banks, we know they're working together, and I'm not saying that's a bad thing, right? It makes sense that you would talk to other central bankers around the world, do all that kind of stuff. But the reason I say that is because nobody wins from a dollar that's moving aggressively higher.
Right. But I think that you would reach a point there where the prescription is to reduce, you either eat it all or you reduce the tariffs to bring down that goods inflation impulse.
Oh, yeah.
And I don't think this would be like a ongoing thing that created, a multi-year problem. But I could see the reason I think this is important is because no one's talking about this. No one's seeing this coming, right? Everyone's short the dollar, pretty sure it's in big trouble. I think more people get convinced every month that tariffs aren't an inflation problem. So if it all of a sudden showed up,
well, yeah, but
the market's not at all ready for it.
And nobody's paying the tariffs yet. I mean, we are, you're right. It is, but it's not
hitting inflation data yet.
Right.
In a meaningful way.
Another example we saw today. So one of the things that we have talked a lot about is one of the dynamics of how, and again, we could throw out several different reasons why. I have no idea if they're correct. I don't know which ones carry more water than the others. But what we have seen consistently in this market is this dynamic where it does not price things in till the last minute. It just walks right into it, right? Platinum and palladium, you've been talking about them for a while. We've been watching those. We've been in and out of that trade, kind of waiting for that to take off. Another perfect example, and for those listening to us, go pull up a chart. You showed me one of the most stupendous candles I have ever seen on a chart.
Yeah.
You showed me the chart, and I literally kind of leaned back and went, whoa. Once again, my prodigious technical analysis skills, truthfully, I can't even really explain to you what a candle is, right? But I've seen a lot of charts, and I know a big one.
There's a lot of green on there.
Yeah. It to me, now it's a much smaller thing, right? You'd be like, Zach, it's platinum or it's palladium, whatever.
Sure.
But what it shows again, and there's no, I don't have a thesis underneath this. I'm not making a case that this means you should do something, one thing or the other. What I do think is people need to be aware of how different the dynamics are internally in this market from the past, where you just see a lot of these bizarre moves where you're beating your head against the desk for like 6 months going, why are people not seeing this? And, goes back, checks notes, checks math. Yeah. I there it is. And then all of a sudden out of nowhere, just boom, right? So if you're at home, go pull up a chart of platinum and palladium over the last year and look at the move
you
today.
Go the last 5 years, no problem.
And so, and to clarify, when we made those comments, we weren't just talking about the market ignoring things to the downside, ignoring downside risks. I'm not really sure why it is. I could throw some random theories at you, but it is just very interesting to see that character shift in the market, because I'm not suggesting something's wrong. I'm just suggesting it's different. Markets are not supposed to work like that. They're supposed to embed information when they get it. This market doesn't do that for some reason.
Yeah. So to speak to it for platinum, for 3 years, you were stuck in a $200 range between about 900 and 1100, truly stuck. And then you went from 1,000 to over 1,400. So you $200 range, and you had a $400 month, like more than a $400 month so far. So like, you just had this giant range expansion all in 1 month.
Again, I wish I could. You know what? That would be actually a great thing to talk to Mike Green about. I wonder if he's noticed it, and I wonder if he has any thoughts on it. Because we've just seen this dynamic over and over. I can't tell you what it means. I don't know exactly why it's happening. It's just, if you've been involved in markets for a really long time, it's just puzzling, because you and I have talked about this other dynamic where we've had to adjust the way we look at things, because there have been multiple times where we're going, okay, if our experience means anything, the fact that this thing isn't moving means that we're probably on the wrong trail, right? We got to reposition things. And then, a week and a half later, all of a sudden we repositioned, got out of it, and then boom, all of a sudden it takes off. And you're like, what? Why now?
Yep.
Why now? So I think it's made things more challenging. At the same time, that dynamic has had an impact on how we do things, at least me internally too, which is just give it more time. Yeah. Right. And that's another encouraging thing for me, because I think one of the reasons that that's starting to work is it does feel to me like this market is increasingly becoming aware of more aware of fundamentals, more aware of the value opportunities out there. And it just feels like you're still getting again. I hate to say the word feels, right? I wish I could give more concrete, terminology,
Vibes.
But I just still feel, it still feels to me like you've got some outflowing of assets to the rest of the world, and the performance of those indexes, I think, certainly backs that up. What else caught your eye today? Anything else of note?
Yeah, well, one thing of note, and I talked about it maybe one episode of the Section 899 in the reconciliation bill, which is basically a way to put a punitive tax on foreigners, which I thought, like we were just talking about people taking money out of America. Like, this is another way to really encourage them to do that. But the G7 has reached some sort of agreement on like global taxation stuff as of right before we started. And Secretary Bessent basically said, hey, Congress, now that we have this new framework we're setting up, take Section 899 out of the bill. I just think that's a very good thing, because I thought that section, some of the fear mongering on it was bigger than the reality. But anything that messes with global capital flowing into America, to me, is a terrible idea. So the fact that got pushed aside, now just because he said it doesn't mean they take it out. But I just can't. I can't. Look, when you look at the position that we're in fiscally and financially here in the United States, you want to talk about we need the capital.
Oh my God! When you want to talk about how stupid Congress can be, talk about a perfect example.
Like I've said before, the rest of the world absolutely takes our buying their stuff for granted. But man, do we take the rest of the world's capital for granted?
Oh, absolutely. And look, there is nothing known to man that will reverse flow faster than capital that isn't being treated well.
Exactly. So I thought that was great news. I was happy to see it.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate and actual performance may differ.
I've made the argument in the past that I think people are like, oh, the dollar is going to be replaced the world reserve currency. And I've made the assertion in the past that I don't think that would necessarily be a bad thing for the U.S. In the short run, it would be. But I think that being the reserve currency has allowed a lot of nonsense, right? It's put a bit underneath the dollar and made it almost immune to downside where it shouldn't have.
It's like giving a kid an allowance for not doing chores.
Yeah.
That's the way I view it.
Yep. Or it's like having a kid go to school without getting any finals or report cards, right? There's no accountability.
If you can make money by just selling money, the incentive to do a bunch of other stuff well is just low.
Yep.
It's just like the Dutch disease problem where, if you're a big oil power, like the chances of you having like a good tech sector and stuff, it just gets low.
Yeah.
Like, because why I can just export all this oil. We're good. For us, we've just been exporting treasuries and dollars. It's like, I mean, you can get some of our Wall Street products if you want, or whatever. But like, other than that, there's no need to be good at making stuff the same way. So I agree that, it can kind of make you lazy in a sense, in a giant macro sense. Now, obviously, how you come down from that mountain of running the reserve currency would matter greatly. But if it's a slow, steady, letting go of reserves status, I think I agree it can be good. As long as we stimulate the things that need to come up to meet that challenge.
Yeah.
It could be good.
Yeah. I mean, it's got to happen at some point, but it'll again.
It's trade-off though.
Huge trade-off. Right. And I get it. People are like, we don't want to lose reserve status. And I'm like, yeah, I hear you.
Free lunches are sweet.
They are. Just what scares you is they also allow you to get way further off track than you otherwise would have.
Yeah,
right?
I think you can see it. You can feel it.
Oh, I mean, yeah. I mean, you've got a socialist that's won the Democratic primary in New York, right? I mean, that has something to do with it, right? Speaking of which, boy, I mean, if you do, is Kalshi got stuff running on that right now?
I think so. Yeah.
Or is Adams the favorite?
Let me see let me see what they got.
Because
I doubt it, but well, if he's not, I need to get in there because
my guess.
I think all these college grads that voted for this guy in the primary will get swamped by serious people in the general. Well,
then, and the other thing that everybody's talking about too is that
so
it's going to pull the Jewish vote out in mass.
So he is 73% to win it, and Adams is only 23%. But like just today, that has actually come in. So it was worse. So he was actually at Mamdani was at 90. So him being at 73 is actually come in. But yeah,
what does that pay? What does that pay?
All right, so if you put $100 on Adams to win and he wins, you make $412. So you get 4 extra money if Adams wins.
I love that. I like that trade.
Same.
Now I don't know. That'll be an interesting dynamic because with what that guy has said about Israel and Jews, they're expecting massive turnout for Jews. But then Adams has got ties to Trump that are not going to help him in that election.
It's true.
You know what I mean?
Yeah.
Just that'll be, boy, the political landscape.
If you're in New York City, I'm sorry, you just lost already. But
well, and you sit there, man. It's like sitting there watching these people laugh on there's way to commit seppuku, right? Like there's like, oh, it's gonna feel great. You're like, no, it won't. And like you and I were talking about, the other thing is, ironically, I think they've got a or a false sense of security because there is no comparable industry in the world or in the United States to the U.S. financial sector. There just isn't. And when you look at the way that works, meaning, we run a management firm, right? You know how much easier it would be for us to change headquarters and move to another state than it would be a plumbing outfit.
Yeah, exactly. There's no plant equipment.
Yeah, or a tech manufacturer, whatever. So my point is, when you think about the revenue that that city and that state generates off Wall Street, and you give Wall Street more reasons to move to Miami or somewhere else.
Wall Street.
Yeah. And then considering that you've got a new exchange being built in Texas, New Yorkers better be really careful, because if they chase a bunch of they got nothing to plug into its place. Not that's going to, not that'll fill in that revenue gap for the city. I mean, they could.
I mean, it would, yeah. So if
they could be, let's
say he could wave a magic wand and get all of his third grade policy prescriptions through, which is he can't, like, just to be clear, but if he could, I mean, it would be just, that city would be annihilated by the exodus of anyone with wealth or brain. I mean,
now if they've got really, now listen though, there's a chance that he has got the type of dynamism and forward thought that our mayor of Seattle has, right? Meaning, if he does really smart things like the mayor of, have you seen the mayor of Seattle's new attempt to stem homelessness? We're doing, we're encouraging and we're sponsoring those homeless people to paint and draw murals on the sidewalks. It's gonna help with the homeless problem.
Okay.
You know, it's really funny being in this environment, because if you sit there and you say something today, you're like, this is the strangest thing I've ever seen. I'm never going to see something like that happen again. I just hold on to, give it 48 hours. You're probably going to see something crazier. Watching that guy talking about the way we're going to fix costs is state-run stores, and you're like,
well, I mean, it's just going to be free everything.
Yeah, I mean, why not?
Sunshine and rainbows.
I love it.
If the guy had a printing press, he could do it, but he doesn't. So, but to be clear, like, he may pivot hard for this election. He could get in office and then find out all the constraints and realize all the things he can't do, or maybe like he gets close to executing on some of these policies, and then 19 really wealthy individuals or firms or both, or we're like, cool, we're leaving, and he's like, oh, well, let's talk about this, so. Yeah. To be clear. And for all we know, this guy is not to be underestimated and pivots hard and ends up being popular and doing a decent job. Like, we don't know.
Look, if he was older, he was older and more experienced, I'd put the percentages higher there.
Yeah.
When you show me a 33-year-old guy that's never accomplished anything and never failed, that is not typically a guy that realizes that he's erred. That's usually a guy that flies it right into the side of the mountain. And when you listen to how confident he is, and how just completely wrong and bereft of economic data that he is, I got to take that threat seriously. Now, the flip side is I think that that's a threat that will get undone really quickly, right? Like you said, if worst case scenario plays out as far as,
400,000 people left the city this month. You're like, oh,
they're nuked.
Yeah, right.
Yeah, they're nuked. And Wall Street, especially, not only can they move, they're uniquely vindictive. You know what I mean? Like, they are and here's the deal. They're not going to want to they won't. They'll just not live in New York 6 months and 1 day out of the year. Right?
It's not even new. Like, people have left New York, New Jersey already. Now, to be fair, a lot of them came back. Like, these people live in New York and not, Austin or Miami for a reason. And for one of it's just like that ecosystem. Like, it's just like Silicon Valley. Like, does it make sense? And if you just first principles this thing to have Silicon Valley where it is, it's like, other than Stanford, no, like, it's a dumb place to have it.
Yeah.
But that ecosystem's there, and it becomes self-reinforcing. And New York is a monstrous self-reinforcing financial hub for a reason. There's so much like powerful inertia there.
I agreed. But an interesting thought. I was thinking about this today. What is one of our most interesting economic targets over the next 10 years that you and I are kind of licking our chops at and looking very, very, in a very interested manner? We're keeping a very close eye on a part of the world.
Yeah, Latin America.
Yeah. Okay. Is there a better financial hub for US-based Latin America investing than Miami?
Definitely not for Latin American investing, and that's a lot of it is there.
Yeah, and I think you're gonna. I mean, again, it depends. Look, you and I both know guys that work there.
Southcom is down there.
Yeah. Well, and there's huge advantages to running money in New York, right? For instance, if you've got a fund of any size, go back and watch The Big Short. So many of those guys ended up in that trade because they were there in New York and got pitched by the broker.
Yeah, exactly.
Right. So when you're not there, you don't get as much access to that kind of stuff. Having said that, that those scales tip at some point. I mean, a lot of big name guys have already moved to Miami.
Yeah.
Right.
But like I said, a lot did go back to New York, New Jersey for, some of us for family reasons, some of us for work reasons, but there is like a tipping point where, that obviously the city has to be careful, the state has to be careful with the way they treat these people. Because if you get to that event horizon and that tipping point has been pressed, then it's just over, Like, let's say everyone just repositions to Austin, and next thing you know, like it starts to become the hub, and let's say UT's finance program becomes really good, and University of Austin finally opens its doors and becomes decent or whatever, like, and they have a great finance program, like, then all of a sudden, like, okay, well, all bets are off now. So if you're New York, just don't tempt fate. I'm not saying don't get a few more bucks out of your billionaires. Like, if you can find a way to do that, you should,
without chasing them away,
to give regular people better breaks.
Sure.
Like, but when you tell regular people everything's free for you, and don't worry, the rich people will pay for it. Like,
and rent controls.
Life's not a cartoon, buddy.
No, and rent controls.
That's
just the willingness.
The craziest part.
Yeah, you and I were talking about just these people pulling these ideas off the trash heap of history, and you're like, look, man, I'm not trying to, like, you know what I mean? I'm not telling you that you shouldn't douse yourself with gasoline and light up a cigar because I don't want you to have a good time. I'm telling you that because it's not going to end well, right? And that's the part where you're just like, okay, have at it. But now New York is different. But for people that don't think that what that scenario you just laid out as a possibility, where New York could permanently be hollowed out to some degree, people remember, because it has been abandoned now for so long and has gone through such a tough stretch. If you went back into the 60s or 70s and told people that Detroit would turn into a ghost town, nobody would believe you.
Yeah.
Nobody would believe you.
But then the auto industry moved to the south. So,
yep.
Now, granted, Detroit's made a nice little comeback here, but it's not what it was in the 60s.
I don't want to talk about Detroit.
Yeah, same reason.
I don't want to talk about Detroit because I remember sitting there circa 2014, 2015 saying, if I had a lot of money right now, which I didn't, I wanted to just go buy up stuff. I mean, there were times they were at the bottom where you could get houses that you had to put a little money in to make them rentable, but you could seriously go buy houses for like 80 grand.
But less, actually.
Yeah, less. Yeah. And
my dad was buying houses in Atlanta after the crisis for 30 grand, and they were fine.
Jeez.
Yeah.
Jeez.
And you could do it there, like Cleveland, Buffalo, Detroit. You could have gone in, and with $1 million, you could have bought a litany of houses. I mean, you could have just had a spreadsheet full of homes for $1 million. That would, I mean, the return on that would have been wild.
Yeah, I mean, if I had a trade,
I had no money, and I was just telling my buddies at work about it instead of doing something about it.
I know, and it just breaks my heart to see it going, because I mean, if I was in the same place financially right then as I am now, I'd literally I'd call a realtor, I'd take a week off, and I'd go there and
take that one, I'll take that one.
Yeah. I'd want to get a place downtown, get a couple rentals, maybe buy some property, and if there were ETFs that allowed for this right now, a trade that I would feel comfortable putting on and letting run for the next 7 to 10 years would be ETFs that shorted the coasts and went long the interior, as far as like real estate prices went. And the reason I say that is because if inflation is going to be persistent and inflation is going to be a problem, and you've got the biggest generation in the history of this country outside of the millennials retiring left and right, going on to retirement budgets, I see it too much in our own clients. I got another client that just told me another client of mine just moved to Kentucky, right? Or excuse me, Tennessee. And they sold their place here. It was a little bit bigger place, but she didn't need that much size, right? And bought a beautiful brand new place down there. And I think she put $400 grand in her pocket was the difference. Yep. And then she said on top of that, the cost of living down here is cheaper. And I think, we're right. Well, prior to COVID, it was this cycle now, the hollowing out of the middle part of the country. It's never going to stop. People just keep going to keep going to the coast. I think that's reversed, and I think it's going to reverse for some time. And it's just
the thing that will really push it is like a nasty downturn, I think, in the economy, where people like how much money you spend on your house isn't like, it's like a necessity to cut it, you know? Because I mean, now if you think about it, like if you're upper middle class, you're a king if you live in Minneapolis or Omaha or Sioux Falls or, you know, whatever. Like you're crushing it. So, but
life is good.
You know, but like people don't want to do it. So, but if you had to, it's different.
Yeah, that is one of the tough things about, I've got so many things keeping me here in Washington, family, work, all that kind of stuff. But I mean, I can easily see kids at college age. I could easily see spending more than half my time outside of the state of Washington. Having said that, when you've grown up on the coast your entire life, like I have, moving away from that water, it's really
and the mountains and the forests.
It's oppressive, man.
And,
I mean,
and the great weather, X 4 months.
Yeah, and part of me sits there and thinks, or part of me sits there and is glad that we have just ridiculous, incompetent leadership in the state, because I honestly feel like this area, in terms of just natural beauty, I think it's a lot of people that have been here get it, but I think it's one of the most underrated places in the entire country.
Yeah, and the whole West Coast really is.
Yeah, it really is. I mean,
if California was run really well, every single person that didn't live there would be an idiot. Like it's just so beautiful and great weather and everything. But to me, the whole West Coast is amazing from a natural landscape standpoint.
It's spectacular. And I was telling some of our clients that live in Florida that were coming up here, they're like, is it a good idea? And I go, yes. No, listen, there's parts of downtown Seattle you don't want to go to, but this area in the summer is just spectacular. I mean, it is just
truly.
There is no better place to summer that I have ever been to in the world than the 85-degree dry Pacific Northwest summer day. For boating, for golf. You can boat and golf in the same day, which I've done. And we'll do a lot this summer as well. It's just spectacular.
This makes me think of the Daniel Tosh joke about, everyone laughing at California whenever like some house falls off a cliff, and like a mudslide or whatever. And he's like, yeah, we live on the cliff because we have stuff to look at, Tulsa, other than a strip mall.
Daniel Tosh. Where is that guy going?
I don't know. I haven't seen him in ages.
He must have gotten canceled for something.
Probably.
Yeah.
Probably for multiple things, but yeah.
Oh, yeah. I mean, I didn't say he didn't earn it.
But,
anyway, that does it for us. As always, guys, check us out on social media. InstaFace is Chase's favorite. But seriously, Instagram, Twitter, TikTok, and on YouTube. We got the video content up. Want to check that out? Just search Know Your Risk Podcast. Also go to knowyourriskpodcast.com. You guys know the drill. Kind of launching kind of a new thing tomorrow. Going to get back to a little bit of the way we used to do things, meaning we're going to do what we call the weekly big show tomorrow. So it'll be an hour-long show like we used to do on radio. I'm going to have Chase join me. Hopefully, are you going to be in tomorrow?
Yep.
Okay.
No.
Oh, you're not. Well, so you'll
I
join
won't
me.
Be joining.
Yeah, next week. But Chase will join me for, 20, 30-minute part of the segment where we'll do the week in review. And then I'm going to do my typical show content that we used to do. We're on the radio all the time. So hopefully you guys will enjoy that. Anyway, have a wonderful evening. We'll see you tomorrow. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.